Now what happens if they don't pay me the money they owe me?
Okay, so we certainly suggest that we bring in either the client themselves bring in, or we advise them to bring in legal counsel that are very knowledgeable about these type of transactions. So they must draft, again, promissory notes, security agreements, personal guarantees, sometimes outside collateral, and put contingencies in there to what happens if the buyer does not pay or doesn't pay on time, and to protect the seller.
Do I get my business back?
If it's in the agreement, yes, but if it's not put in the agreement, which most of the time people don't even think about, no. So it all depends on how we draft it and how we negotiate it and how we get help with your legal counsel to make sure that you're protected.
Besides an attorney, who else would be a good advisor that I should be in touch with?
So definitely your CPA, your CPA and your financial consultant, can be your financial analyst. Sometimes we hire an outside financial team to help, because CPAs typically file what happened in the past. So they file last year's tax returns, but financial advisors also plan for the future, and they can help with the projections which the lender or the buyer will ask for, because they also buy in the business for the future outcome. So the CPA and financial teams are very vital, other than the attorney. The lender is definitely great source for the buyers. Sometimes we have consultants, business coaches. We may have a business partner that's experienced enough to help with the transactions because they've been through another sale in the past. And sometimes we have another broker representing the buyer or the seller on the other side that hopefully is a knowledgeable expert and helps the sale.
So once the buyer buys my business, how do they learn how to run my business?
That's a wonderful question. You want to make sure that your broker advises you on that, because we want to put in contingencies there that the seller actually helps with that transition. Okay, so they don't just sell and leave tomorrow, because they're the ones that created that business most of the time. It's their legacy. They know it the best. So the longer they stay to help us meaning the buyer, the more successful we will be. So we can put in clauses like post-management agreements. We can do rollover shares where they're going to be owners of the new corporation that bought the business. Could be minority. We can buy them out in the next 2, 3, 4 years. They can be contingencies where a certain amount of the closing proceeds are held in escrow and released in monthly or quarterly terms to make sure they stick around. So if they promise to stick around a year, we can place X amount of the closing proceeds, for example, 10, 20% in escrow, and release it monthly, like it's salary, to make sure they help us. And if they stay that term, they get all the money. If not, it reverts back to the buyer.
So going back to my original question about what you do, from your experience, what documents would I, as a business owner, need to have available to you?
There's a lot of documents, and you need to work with your team of advisors, mainly your CPA, compiling them. But basically, you must get your last 3 years tax returns, a current year P&L, profit and loss statement, a current balance sheet. For the due diligence, we're gonna need to have access to your bank statements, which we could get at the front end or during the due diligence stage. The sales tax records, whether it's a sales tax paying business, which not all businesses are, but if it's a sales tax paying business, sales tax records, payroll tax records, account receivable, account payable, agent records, because to the buyer, it's very important to understand the balance between account receivables and payables. They need to know if they have to write 2 checks. One is to buy the business and the second one is to run the business. If there's a discrepancy between account receivables and payables, what I mean by that is they have to wait to collect money, but they have fixed expenses they must pay tomorrow. There's a gap in between. They must know how much that money is to make sure we have that money available for them, whether with their liquid assets or maybe with the working capital line of credit at closing, so they're successful running the business.
I operate my business successfully, but I don't own the real estate. I have a landlord and I pay monthly rent. How does that impact my sale of the business?
That's another great question. Most of the time, that's the typical scenario where a business owner may not own the real estate, but they have a lease in place. Hopefully, because sometimes people actually let the lease lapse, and that's a difficult sale then, because the landlord may come and ask double the rent, and then that affects the buyer's net income, and that affects the valuation of the business. But hopefully there's an existing lease in place, and we do what's called a lease assignment at closing. So it's basically a transfer of the lease to the buyer with the same terms. Even if there's options, they get to inherit that. There may be some fees associated, like application fees, transfer fees, and of course the landlord has to approve the buyer, and the landlord will ask for some financial qualifications and also if they have experience running such business in the past. But that's one of the contingencies to the sale, which is a lease assignment approval. It can be done. So the buyer will assume the lease and buy the business with all its assets and continue operations.
Now, does the buyer buy the business and all the stock in the business, or are they just buying the equipment in the business? And explain what FF&E. I hear this FF&E. I don't understand what that is.
So FF&E stands for furnitures, fixtures, and equipment. So anything that's in the... So I always give this example. So turn the real estate upside down. Anything that falls is FF&E. Anything that sticks is leasehold improvements, which is construction. Okay? So FF&E is all the falling assets. So another great question about the difference between asset sale and stock sale. So the stock, they're basically buying the corporation with the name and the stock of the corporation and their personal name or another corporation they may have, which inherits the lease. If there's a real estate, by nature, yes, and if there's cars, any type of equipment, any type of contracts or agreement that's in place, it's inherited. But it may inherit some tax liability. So although we put in place some indemnities that says the seller is responsible for the past, if the IRS decides to come in and they can't find the seller, then they may have to go after the buyer. So stock sales are not always preferred. There's some instances where it's a must, typically in a business that has hard to get licenses or has a lot of contracts that are going to be very hard to transfer or renew with the buyer. Hard to get license industry maybe mainly in the medical field, especially in home health care industries or licensed nurse registries, where typically a stock sale is preferred. Stock sales are more advantageous to the seller because it's triggered as long-term capital gains, which are 20% rate. But asset sales are treated as ordinary income, which are higher. So it's less preferred by the seller, but more preferred by the buyer. An asset sale, the stock is not assumed. Typically, they form a new corporation and they transfer all the assets, which can be the FF&E, the lease, contracts, social media accounts, phone numbers, customer information, the goodwill, the brand name. We call it the fictitious name or DBA, which stands for doing business as. They transfer all that and the employees to their own corporation. So that's the difference between asset sale and a stock sale.